Today we're going to talk about DSCR loans, what they are, who they're good for, who they're not, how they help you make money, maybe when you don't have the experience, the W-2 income, or even if you just want an easy loan. So today you might have heard about them. They've been around for a few years and they're getting more and more popular. So let's dive in and see what a DSCR loan is.
Money, 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 hard money, money for real estate investing. Let's make money, 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 hardmoneyMike.com.
So what is a DSCR loan? It really stands for debt service coverage ratio. It's just a term that's used in the mortgage industry. But really what it is we call it an easy loan because it takes out a lot of the paperwork, probably 50-60% of the paperwork. And if you've ever done a loan for a rental property or a rental portfolio, you know there's a lot of work. So the debt coverage service ratio loan is the easy loan because all it does is it looks at your property, your rental property, and does the rent cover your monthly expenses. So as long as at the very least your rents cover the expenses, the payments, the taxes, the insurance, the HOA, and you have a good to great credit score, you could get what they call an easy loan or a DSCR loan. The industry out there it's a little bit different than your standard loans, your traditional loans where you have to do all the paperwork. DSCR loans come in many shapes, many sizes. Each lender has their own nuances because there is no national underwriting for DSCR loans. So there's literally hundreds of different programs out there with little tweaks, and there's thousands of different entities offering these products out there. So you really do have to shop around. You really do have to look for them. But if you're looking for a loan that will finance your investment properties in 30-year loans, 3, 5, and 7-year adjustables, interest only, anything like that, DSCR loans are a great option that you have to at least look at. The biggest difference is you're going to have to shop around, look at different lenders because each of them will fit a different criteria for a different loan or property that you do have. So DSCR loans, they are going to typically require like 20% down for a purchase. If you're doing a refinance, the max is usually 75%. Now, like I said, there are some unique lenders out there who may offer a little bit more, but you're going to pay for those in higher rates. And rates on DSCR loans are typically around 1.25% to 1.5%, higher than your traditional conforming conventional loans like Fannie Mae and Freddie Mac. The other unique thing on DSCR loans, unlike standard loans, they almost all come with prepay penalties. And what that means is you're going to have to keep the loan for a certain amount of time. Usually it's 3 or 5 years, or you will pay the lender a penalty for paying it off early. That means if you sell it or refinance it, they're going to charge you some kind of penalty because when they get into these loans, they want the loans to stick around for at least a certain amount of time. That's what they're anticipating when they're lending you the money. So unlike traditional loans, they are going to come with prepay penalties. So you're going to have to watch that, make sure it fits into your guidelines, and understand those prepay penalties, even if you sell it or refinance it, you're going to pay those if you do not hit at least their minimum time frame for the DSCR loans. So let's look at some pros and cons of DSCR loans. I mean, the biggest pro is that they don't require income from you personally. You don't have to have a W-2 job. You don't have to be self-employed for 2 years. They don't even care about that. That should not even be on the application where you work, what you do. So technically, you could have just become self-employed one day before. You could have just started a new job. None of that matters. So the biggest benefit here is, especially people who are starting out in this industry, you have a loan product that you don't have to have 2 years of history to make it work. They're just going to go off of the rents on that property. So that is a huge benefit. Another benefit is the majority of them allow you to keep them in LLCs, finance them in LLCs, or any other kind of business. And the majority of them also will do loans in multiple states. So if you have properties in Colorado and Florida, you could go to one lender and they can lend anywhere because what they are considered business loans. since they are non-owner occupied. So as I mentioned, if you've ever gone through a loan underwriting and it was through the traditional or other non-QM loans, you find out that there's a lot of headaches, a lot of work, a lot of paperwork they need, and it never seems to stop. The beautiful thing about DSCR is it's a simple loan. They're going to look at your credit, so you have to have good credit. They're going to look at your loan to value, and they're going to look at your rents. That's it. The majority of them, you don't even have to give them all the information on your other properties. And also, you can have other properties that are negative cash flow, and it doesn't matter because they're not going to look at them. They just want to make sure the other properties are current, and that'll come up on your credit. So as long as you have a property that's making money, you could get into a loan like this with little to no paperwork. Now, what are some of the cons to the DSCR loans? Number one, like I said, is the prepayment penalties. I talked about that in the first segment. But prepayment penalties, especially if you find someone who wants to buy it or you want to move on or something comes up and you have to sell the property. Prepayments can be up to 5% of the loan amount. So if you have a $200,000 loan and you have a 5-year prepay and you want to pay it off or sell it or something in 2 years, you're going to pay them 5% of $200,000 or $10,000 just to get out of the loan. So that's a huge difference between like a DSCR loan and a conventional or some of the other non-QM loans that are out there. So you really have to look at that. The other thing are rates are of course higher than on the conventional side. They do have some good products now coming out, with some 5 or 7 or even 10-year ARMs that keep the rates a little bit lower, but you're usually going to pay somewhere between, 1.25, 1.5 at the very least, higher than conventional. So it will impact your cash flow. So it has to be a very strong cash flowing property to look at a DSCR loan. So DSCR loans are a great option. It doesn't matter if you're looking for, a 30-year fixed interest only. They come in all shapes and sizes. It is a great loan. It's a great portfolio loan. It's ideal for those people who want something easy, who don't have the income that traditional banks need, and then the property's cash flow, and they can take on that extra, 1.5 to maybe even 2 points, depending on where your credit is, in mortgage interest rates and stuff like that. So as long as it fits and as long as the cash flow is there, the DSCR loan is a great loan, an easy loan, and it's a way for you to keep growing your portfolio without going through all the hassles that underwriting and traditional loans require. So part of understanding the DSCR loan is understanding the DSCR calculation, because all lenders are going to look at the calculation, the DSCR calculations. So I want to go through and actually do the numbers so you could take this. We actually have a little Excel spreadsheet on our website. If you want this particular way of calculating, you could get that too. We'll have a download below. But let's look at an example so you actually could do this, run this by your own numbers, make sure it's cash flowing for you, because you're gonna have to know your mortgage payment and stuff. So let's look at a DSCR calculation and how lenders look at it. So number one, the one thing they look at is the income. So let's just say our rent for this property is $1,000 a month. So that's our income on the property. So the next thing that they're going to look at is what are the expenses? What are you paying out? Because they want to make sure that this will cover your total costs. They look at mortgage payments, taxes, insurance, HOA. At this point in time, they do not look at property management or anything else like that, but things can change. So let's look at an example here of a mortgage payment being $500. Your taxes, being $100. Your insurance being, let's just call it $50. And your HOA, $200. So every month, these items go out, and that's what they're looking at. What are your monthly costs? So we have $850 here. So right off the bat, you could see that this property cash flows positive $150. And that's what they're looking for too. They're looking for this property to cover it. So we want to make sure that this calculation is correct. So the expenses into the income shows that our debt ratio or our income is greater than our output. So here we have a ratio, and I'm just going to check the numbers again, 1.17 plus. So this is what the lenders are looking for. They're looking for something that's a positive cash flow. They're looking for something that has a minimum of 1-to-1, meaning your rents will at least cover this mortgage. That is the minimum requirement for a DSCR loans. Now, there are no DSCR loans out there where this could be higher than this, but you're going to pay a lot more in rates. But those products are out there too. We're talking about the pure, true DSCR. But what they really like is they like to see this number at least at 1 plus, because they know if you have rents and they are more than your expenses, if anything comes up, you have a little bit of leeway there. And they love to see properties that bring in 125% basically over what your rents are. So you're actually cash flowing, you're actually putting money into your pocket. But at the very minimum, all you have to do is have your rents cover your expenses. And the simple calculation is just divide the cost of what your monthly expenses into the rents that you're receiving. That's all the calculations they do. That's all they're looking for in this loan. So without all your tax returns, without your W-2s, without verifying all these other properties, that's what makes the DSCR loan so attractive, so easy for people. And it's really something that can help you grow your portfolio and your cash flow, as long as, just like you want to make sure your rents are higher than your expenses, so does the lender. So that's how you calculate. And we'll have a little spreadsheet on the bottom that you could also use to quickly calculate where your DSCR is for any property to see if your property even qualifies for a true DSCR loan. So another thing to understand on DSCR loans, what is the down payment requirement? What do you need, or how do you, what is the maximum you could cash out or rate in term? That's what we're going to go over here. Like, what are the terms? What are the requirements for the down payment? And also, where does that money come from? So number one, if you're lucky, you're getting into this and you actually BRRRR a property where you buy it under value, use a hard money lender, you can use DSCR just like any other traditional conventional loans to actually refinance in. And if you buy it right, if you buy it in that 75% or below, you could actually use a DSCR loan and buy a rental property with zero down. You'd have to go through, look at some of the BRRRR videos, how you do that, how you find that magic number, and everything else like that. But typically what you're going to find are DSCR loans are just like any standard loans. Your typical loan right now for DSCR is 20% down. Now, things might tighten up. We've seen a couple lenders actually go to now 25% down. As rates go up, things tighten up. So you have to watch that, but typically it's 20% down. That means if you're buying a $100,000 property, they're going to lend you 80% of that, or $80,000. You're going to have to come up with $20,000 for your down payment. So pretty much like most standard loans, that's what you're going to find in the real estate investment. As you go up, if you go from a single family to maybe a fourplex, and some of these DSCR loans even work for fiveplexes up to sixplexes, you may be required to put in the 25 to 30%. As your doors go up, sometimes your down payment will go up too. Check with your lenders. As we said in the segment before, there are a lot of different programs. DSCR is like the Wild West. Everyone has their own uniqueness that they like in the loans. So there's a lot of different choices out there. So the other thing is if you're just refinancing a property, if it's a rate and term, which means you're just paying off the old mortgage, you're not taking any cash out above like 1%, typically you're looking at 75% in this market for rate and term. So you're going to need 25% equity in the property in a DSCR loan just to do the rate and term. On cash out, they're a little bit tighter. Some of them are at 65, most of them are at 70. I'm not saying you can't find an outlier that maybe even go up to 80%, but you may go up 2 or 3 points on your interest rate too. I'm talking about the true, good rates, good loans on DSCR loans. You're going to be maxed out at 75% for rate and term, cash out 70%. So if you're looking at a property, if it's worth $100,000, on a cash out, you can only go to the $70,000. You need that $30,000 in equity. If you're doing a rate and term, 75%, or on a $100,000 property, you must have, the maximum they'll lend you is the $75,000. So a lot of standard items here, but like I said, there are so many different programs. There's so many different people out there. Talk to different brokers, talk to different people, find out the ones who have many options. We do DSCR loans. We have at least 20 different lenders that give us different options for different programs. A DSCR loan from one company may fit you perfectly for one property and it may not fit you for the other. So make sure you shop around, look around, and get the best terms that are for you and your property to maximize cash flow, because that's why we're in this. Keep the cash flow, increasing the cash flow. Make sure the property is bringing you in money, not costing you money as you go through. The last part we're going to go through in DSCR loans and where they work are the DSCR loans at Airbnbs. Can you buy an Airbnb with a DSCR loan? And the short answer is yes. There are some other hurdles you'll have to go through and look at, but typically what a lender will look at for an Airbnb is two things. Do you have, if you're going to refinance it, do you have a history? Do you have 2 years of history that they could actually look at the rents, look at the expenses for that particular property, and use it to qualify? If you can't do that and you want to do a DSCR loan on a short-term rental, Airbnb, VRBO, whatever you call it, you're going to have to use the standard rates, the standard rental rates for a standard rental property in that area. So you're not going to be able to use the VRBO Airbnb income if you don't have it established for at least a couple of years. So if you're buying an Airbnb and it doesn't have any history and you're using DSCR loans, what you're going to have to do at the best is they'll let you use the rates that other people in the area charge for standard rentals. Sometimes that's a big hurdle because people, when they find a good property that's good for Airbnb, they might pay a little bit more. They may stretch it a little bit more because they're looking at, bringing in rents that are anywhere from 2 to 4 times that of the standard rates. So it may not qualify, which means you may have to bring in more money. Lenders, for some reason, still look at Airbnb as a little bit riskier. And I think there's because there's moving parts there. There's management. There's, municipalities who are making them illegal. So then they have to revert back to either a traditional loan or standard. So you're going to find as Airbnb, DSCR loans will work. They'll probably work with at least 70-80% of the people out there lending DSCR loans. The other 30% don't want anything to do with it. So once again, shop around. The biggest thing with investing in the money side, there's a ton of money in the money, and the less friction you have on the money side, the better you're going to be long-term investor. So shop around, look around, because you might go to one bank or entity and they'll be like, we don't do DSCR loans, we don't even know what that is. Number 2, they may say we don't do any VRBOs. You just have to shop around, find, reach out to some of your friends that who are investors, go to Bigger Pockets, wherever it is, find the lenders who do this, because you can buy properties that are Airbnb with DSCR loans. You just have to find the right company, and the right company that'll give you the maximum loan to value, because some of them will cut you down to 70%, and you really want to find the ones that'll do 80%, and they're the ones who will use the standard rates and rents in your area to qualify for that property, even if it's going to be an Airbnb. I know a few other people, what they've done in the past is they started out as a short-term loan. They started out as a traditional rental, and then they moved it later after 2 or 3 years into the short-term loan. And one thing to understand, because some people kind of get confused, you can do the conversion as long as your intention going into the loan was to keep it as a traditional rental property. You can convert it later to an Airbnb. And you don't need to let your lender know anything else like that. Just keep making the payments. They don't know year to year where your rents are going. They don't know year to year what you're doing with the property. If your intention was when you bought it to have it as a traditional rental property, you could do that and then convert it later, a year, 2 years, whenever you want, into that short-term rental. So that's also a strategy that I've seen people do. Start them out as regular rentals and move them to the Airbnb. So today we went over DSCR loans, where you could use them, the pros, the cons, everything else like that. If you have any questions, reach out to us. We'd be glad to help you with any questions, how to calculate, how to figure out if there's an option for you. We'd be glad to hear from you. Also, we have a download below that you could look at other lending options, because DSCR is just one lending option. So what do banks do? What do other mortgage brokers do? What are your other options just besides DSCR? You should understand all your lending options for all your real estate investing needs, because, like we say, there's money in the money. If you can understand the money side and make it easier, faster, cheaper, life in real estate investing is going to be good for you. Now, if you're new to real estate investing, DSCRs, anything else like that, you really need to understand the money side, because there's money in the money. This is half, at least, of real estate investing is not only understanding the money, but finding the money, finding the cheapest, fastest, easiest money you can find to put less friction in your business. We have something we call the 30-day Fuel Up Challenge course. And what it does is it helps you understand a little bit more about the money. It helps you find the money people, from the banks to the hard money to just traditional OPM, we call it other people's money, just people off the street. It's something you need to understand if you want to be a successful investor. So we'll have a link below. Come and join us. Get ahead of the competition. Understand the money side. Only about 10% do and will do that. Be that 10%, because it's going to make your investing a lot easier, a lot faster, and you're just going to make more money doing this. So enjoy your day. Thanks for joining us, and we'll see you on the next video.